I followed Tom and his firm for a long time, and their methodology is just different. I think it's forward thinking. And so if you're not incorporating some of that, which Tom does, I think you're going to miss out.
We do pick up because we are forward thinking. We're looking out typically at least 3 years into the future to capture the growth of that's going on.
That's Roger Viome with Alex Brown and Tom Cole, CEO of Distillate Capital. We'd like to thank Tom and Distillate for sponsoring the live ETF Think Tank Exchange and this podcast. I'm David Dziekanski.
And I'm Kedar Wilson. This is episode 205 of the Think Tank Exchange podcast. We're asking the question, are you thinking forward on value investing for your clients? Thanks for joining us.
Cool.
Hello, David.
How's it going, Kedar?
I'll remind our audience that our focus here at the ETF Think Tank Exchange is to provide thought leadership by bridging the gap between investment producers and the advisors who use their products through actionable ideas.
Today, we talk about unique ways to access and assess value. And in changing markets where the shift from tangible to intangible assets has been massive over a multi-decade stretch, finding unique ways that don't end up in value traps of finding ways of capturing value is supremely important in this marketplace.
Yeah. Well, let's get back to Tom, Roger, Dan, and David as they continue the conversation.
Years within the industry, you've seen the markets go through cycles. And Tom, that's where I want to start out today. Value investing has gone through periods of time where value has outperformed growth, or at least that's what I would call the standard, kind of the basic view that most people have. Since, if I look back at some of the performance, since 2007, growth has outperformed value, but it may be a surprise to many of our listeners that value outperformed growth for 7 years before that. Can you talk about what's happened in the world of value investing? It seems like it used to work, but I don't know if that, what I would call conventional view, is accurate or not. Help us think about that.
Yeah, so, value investing came into vogue a long time ago. And when you look at the historical numbers going way, way back in time, value outperformed core and growth almost over any long-term period. Up and down the market cap spectrum. So it had a long history, and not surprisingly, it developed a very big following. If you simply bought low price to book stocks, it worked in terms of adding value over and above market returns. It worked until about 1989. And then I would argue, with exception of a few moments of brilliance, including, coming out of the TMT bubble, that it's largely failed. The issue isn't really as much about the style being broken as it is about the tools that we have used to measure value historically becoming less useful as the underlying economy has changed in the last couple of decades. And we think that is a very big issue in the context of the reasons value has struggled in here. And it speaks to the frustration that a lot of people have had in terms of waiting for value to recover.
Roger, Tom makes some great points about what's happening in the value space, but there's some complicated ideas in there. Are those the kinds of topics that your investors are thinking about or have an awareness of? Or is there a way that we need to think about contextualizing this for the investor?
Yeah, I think that I do a lot of due diligence on ETFs, and I use, DeRosa and their group a lot to aid in that due diligence, and have for years. But the boom in ETFs has opened up, so much opportunity and different ways to invest. I think the average investor right now sort of views value as what hasn't participated in the COVID move upwards. And it's everyone's sort of waiting for this shift. When are we going to have a value shift? But what they're really talking about is a shift from all of the stocks that didn't participate in this nice COVID run. And I think so. There's a little bit of misperception there that those are all value stocks, and people are thinking that gaming and leisure and travel and things like that. Everyone's waiting. How do I catch that? And before its big move, when we're in a post-COVID world, and and I think they're all labeling that as value, which I don't think is necessarily the case. I've followed Tom and his firm for a long time, and their methodology is just different. I think it's forward thinking. It incorporates some of the digitization of the economy, which has really happened. I don't think we're where the average investor may be wrong is that stuff may not come back. Some of that stuff that they're waiting for the rally. And so if you're categorizing value the old way, you may be missing what's truly value now with the way that Tom and his team sort of evaluate companies and opportunities going forward. So I think there has to be a forward-looking mindset and realize that the famous thing that nobody wants to say is that maybe things are different this time. I think it may be a little bit different this time, that there has been sort of this 10-year shift in digitization pulled forward, and that some of these companies will continue to thrive. And so if you're not incorporating some of that, which Tom does, into your value sleeve, I think you're going to miss out.
We're talking about contextualization, right? And what people, I think, often forget is that David Dodd and Ben Graham were born in 1846 and 1894. And the security analysis book was published in 1934. Hey, listen, a little tidbit from the professor, what can I say? But, when I look at value investing, you have to have a forward outlook. And you have to have some innovation as well in the context of the companies so that they actually have some growth as well. You're getting discount on what you're buying, that matters, right? But you're also getting some growth. So, when I bring that up, I'm trying to speak a little bit about how Tom's firm analyzes the future as well. So, Tom, you guys do a great job of that, and I like to say, hey, a tidbit from Weiskopf, structure matters, and your analysis has really helped, flesh out where the value is, and quite honestly, also where to avoid the value traps.
Yeah, I would like to agree with you, Dan. I think value comes in lots of different flavors, if you will. Value as a strategy, kind of inherently a contrarian thought in it that, something had to be old, sort of the, cigar butts or rusted or smokestacks. But I think the truth is, and behavioral economics kind of points to it, that people make mistakes in all sorts of different ways. They can be not optimistic enough on certain things that are going well, and can be skeptical or too anxious to see mean reversion when there really isn't any evidence that there is some going on. So, stocks that are continuing to do well, we do pick up because we are forward thinking. We're looking out typically at least 3 years into the future to capture the growth that's going on. We like growth fine. We just don't want to pay too much for it. And we call ourselves value investors because it's seemingly the opposite side of that is what you pay doesn't matter. And certainly that doesn't make any sense to us either. What you pay obviously matters. And we think, some of the biggest risk in that.
Hey, Tom, one thing we've kind of skipped over, which is our definition of what value is, or your definition of what value is mostly defined by free cash flow, right? Can you speak a little bit on how you do that analysis to identify, what's good, what's not?
Yeah, so we do utilize free cash flow solely to measure valuation. And we did that because with the accounting that we are given, no matter where we are given it, domestically or internationally, we can reconcile to a free cash flow number. And that allows us to make accurate comparisons across industries and within industries to measure relative valuations. It's really kind of as simple as that in concept. Now, in practice, you need to understand the accounting. You need to understand both the numerator in terms of what is free cash flow and where there are accounting pronouncements that you need to make adjustments for. But then we compare it to enterprise value. And there again, you need to understand the businesses in some detail in order to make appropriate adjustments to get things as closely as you can to an apples to apples comparison.
So, Tom, then with the adjustments that you guys make, I tend to think of value investing as kind of hard to implement. As Roger had talked about earlier, a lot of people have been using value-based investments or what they think of as value-oriented strategies, and they're waiting for them to come back, to use some of the common vernacular. If we look at those investments through a traditional metric, price to book or PE ratios, that would almost suggest that the kinds of investments that people are thinking about would appear to not be working. But it sounds like you have got a different perspective on what is and isn't working. Is that correct?
Well, yeah, David. I think, the way the benchmarks themselves are defined largely on the basis of price to book value. And going back to this conversation about, the old economy and the new economy, certain companies have book values. Big financials have book values still on the balance sheets. Energy companies have book values. So when you look at the value benchmark, what you see is a disproportionate share of those businesses that have large legacy accounting book values, and you see an absence of companies that don't have book values, meaning a lot of things around branding and technology and software and the like. And so, the value benchmarks themselves have sort of become artifacts of accounting rather than a representation of price to worth. And I think, that's at the heart of the issue around people waiting for value to recover. They're waiting for, they're often tied either by buying, an ETF that's directly tied to the benchmark, or by buying a strategy that's closely tied to that benchmark. They're tied to a group of stocks that, sadly, kind of oftentimes struggle to meet their cost of capital, and it's a very difficult place to ultimately perform. So I think you look at the situation right now and assess whether it pays to wait, and we're sort of in the camp that it probably does not, and that a sustainable return to value investing, at least as it's primarily defined by the marketplace, is something that you could wait for, into perpetuity.
Hey, Roger, just coming back to you here. When you speak to clients about value, are they, what's their reaction? Do clients say, "Oh, well, I don't understand why we need to be there"? And you tilt and say, "Listen, this is about diversification," or do you emphasize that I want to pick up a nickel for 3 cents, right? How do you speak to clients about value?
So wealthy clients always wanted value, right? They always wanted MLPs, and in times have changed, and life moves forward, and if you don't adapt, it's sort of you miss out. So if you've been sitting on value over the last 5-6 years, you've been missing out on some great returns if that was your sole way of investing funds. From an ETF standpoint, I've sort of been involved in the evolution of the ETFs, with DeRosa and them, where it's, it went from low cost investing to sort of, smart beta or kind of gimmicky almost investing. Let's take why invest in the S&P 500 when you can use just 300, and we back test it and it's outperforms. Everything was back testing. And now I feel like as it has matured, we really have some creative ideas that, and distillate being one of them, that really has it can show outperformance because of its thematic sort of methodology. And when you look, 2020 was a great example of it. Our models are, we have some low cost ETFs just for passive exposure to the markets, both in US, international, emerging markets. Then we have some of these thematic, ETFs. And, the thematic ETFs, if you're an emerging market ETF, you're up 30% over the past 12 months. If you're in an e-commerce and social media emerging market ETF, you're up, 100%. And same thing as, if you're in the, passive US ETF, or if you're in something that, contains blockchain or e-commerce or what have you, you're up 80 to 100% over the same time period. So that we've seen significant outperformance in these thematic ETFs in the past year, and that's continued into 2021. And I think that will continue going forward. And that's not because I think it is because they are actually incorporating sort of forward-thinking investment ideas without actually being an active manager per se. So it's
Roger, you bring up something really important, which is all about active share, right? Doing something a little different. When when we look at an ETF specifically, we're looking for high active share solutions, right? And you do the same thing, right? Where you want to invest in a certain portion of your portfolio in something that's doing something different. How do you go about doing that?
Yeah, I think it's we work again with the DeRosa and the group, but they where we analyze this on a monthly basis and the active share in our portfolio. We start with a blank sheet of paper and an asset allocation globally, and then try to figure out where we want funds allocated and monitor sectors and styles and different things like that. There's a plan behind it, but then with the execution vehicles themselves, we sort of look at, again, we have like three buckets. We have a bucket of just low cost, sort of 2 basis point type passive exposure in the United States, and then and if we have some thematic ideas within the United States that fit our asset allocation, we look to take advantage of those as better execution vehicles. If we don't, or if we feel they run their course, we sort of default back to the low cost. So we're also kind of monitoring costs as associated with this. And then sort of as a third bucket, we have we do use some money managers who have consistent, great stock picking track records that aren't purchasing things that are in the indexes. So it's if we're going to pay a manager, we'll make sure that we're not getting that exposure in the indexes. So it's with those three buckets, call it low cost, medium cost, and higher cost. Cost is a factor. Active share is certainly a factor when we monitor the entire portfolio. And I can take it back for 1 minute and just say, when we initially started investing in ETFs, we were following a lot of research and said, let's invest some money in Brazil, and let's put some money in Hong Kong. And when we met with the group at DeRosa, they said, well, what are you trying to accomplish? And we said, hey, there's a rising middle class, and this was years ago in China, and we'd like to take a consumer angle into it, et cetera. And Mike said, well, you realize that ETF is 80% real estate, and your Brazilian exposure is 50% two stocks. And we didn't. And at the time it was, hey, we want some exposure, and it was sort of iShares was sort of like the only exposure at the time, where you just, hey, if you wanted a sector player, you wanted a global play somewhere, you just kind of grabbed it, but you didn't know what you were getting within it. And so we really get the benefit of seeing what's under the hood in these investments when we analyze it in those three buckets, both in the passive, sort of the thematic, smart beta ETFs, and then the manager. When it's all put together, we can see, we get a call from a client saying, why don't we own Tesla? Why don't we own that? So we do own it. and here's what percentage we own. You just don't see it because you have a portfolio of 20, ETFs. But once you dig under the hood, you realize you have a great portfolio if it's set up right.
Like many asset classes in markets, trends can last for 5 to 10 years. In a world where information is at our fingertips at all time, it's hard to ignore the day to day.
Oh, well, looks like that's my Robinhood app on my phone right now.
We've turned trading platforms into essentially casinos, and they're designed to intrigue you in the most risky trades.
Yeah.
And it's really hard to assess trends then, again, that may last for a decade.
Yep. And it's really interesting points thinking about forward thinking. I think the lines have been skewed, especially with the retail investors that, have been definitely moving the markets lately when it comes to their understanding of value versus growth and the long-term view and forward-thinking view that you need to have when it comes to value investing. So I loved how they touch on all these things in this segment.
We've seen more option volume than ever before, and specifically from the retail trading standpoint. And that just doesn't really align with long-term market cycles.
Yeah.
Dan, question?
Yeah, no, I mean, I guess my question would be for either Tom or Roger, in this marketplace, how are you viewing risk, right? Risk, both from the vantage point of drawdown, as well as what would lead to a comeback if that were to occur, because markets do come down, and sometimes it's how quick they rebound that matters. Whoever wants to go first.
I kind of hinted at it already. Our view is that, the leadership in the market does look expensive. So if you look at the overall free cash flow yield of the S&P 500, it's certainly below the long-term average, meaning that, we're more expensive than average looking back. But if you eliminate the top 6 names, so it's Amazon, Facebook, Microsoft, I won't get them all, but you can imagine Tesla, that takes the yield on the S&P by itself down a fair amount. So without them, the opportunity set is pretty reasonable versus history. And that, flies in the face of PE ratios, which suggests we're in kind of nosebleed territory. And then, on top of that, with selectivity, we can improve the opportunity set beyond that sort of meaningfully in the U.S. and even more meaningfully internationally. So I don't know if that kind of gets to it, Dan.
No, it does. Roger, how do you view risk?
Yeah, I mean, I'm generally bullish. I think our economists at our firm, feel like we're in early innings of a bull market after the correction, and I think that there's smart arguments, as in most times, on both sides of overvalued and undervalued, and what's to come. From a risk standpoint, what keeps me up at night is really sort of trying to think about what could happen that none of us are thinking about, and new issues that come about are with the Robin Hood type trading and the Bitcoin, and when companies take Bitcoin and they're almost with their corporate cash in size, and that has a meltdown. How can that affect things? And just I think there's risk out there in sort of the trading that's going on in certain things. A lot of things are changing. There's SPACs that are just, every day. There's new IPOs, and I think there's been over 50 billion, year to date already in the first 6 weeks of the year raised in SPACs, and much more in the pipeline. And I think that, these are all new things. So it's, where they play out, I think, and how it all plays out will be interesting to watch, and certainly it's worth monitoring from a risk standpoint. Outside of that, I feel pretty good about where we're at. I feel pretty good that the market environment with rates and everything else is very accommodative, and I feel like what worked last year is going to continue to work this year. Again, sort of on the digitization of things, being 10 years sort of push forward, and those companies continuing to grow. One thing I wanted to add on on Tom and distill it is that it's important to know from an investor or an advisor standpoint, when you do your due diligence on these ETFs, if you do a quick dive into due diligence, you can look at, distill it and say, well, of course he's outperforming. He's cheating on value. And I think that would be an old school sort of mindset and thought process that say, well, he's got growth stocks in there, and it's important to know that is an old school mindset. And you have to dig into the methodology and why it makes sense and why his view on valuing value companies and corporations is different, and why it makes sense in the economy that we're in today and going forward. So I just throw that in there because, I think that the average advisor or investor will look and look at the holdings and say, well, that doesn't make sense. He shouldn't be holding that. He's a value investor and he cheated. And it's not the case. It's a completely different way of viewing value, and it's in my mind makes complete sense. So I just throw that in there.
So I guess in the conclusion, in the spirit of charity, if Roger, you have a charity in mind, we always like to ask away, because it can't just be about making money. It has to be also about giving money.
No, that's great. Yeah, happy to plug. I'm on the corporate board of the James R. Jordan Foundation in Chicago, which is really there to sort of level the playing field through education in some of the city's most underserved areas. So we support 4 schools, one in Englewood, 2 on the west side near the United Center, and then one in Rogers Park. It used to be sort of Michael Jordan's foundation, which has moved on to North Carolina. So now it's run by Dolores Jordan, his mother, and a group of us. So it's still active in the city. I'm very active with it. We do plenty of fundraisers, so always happy to talk to anybody about that whenever I get a chance.
Thank you, Roger. Thank you, Tom.
Yeah, thanks, everyone.
Well, as we wrap this episode, we'd like to thank Tom Cole and Distillate Capital for sponsoring this podcast and the live show. And of course, we thank Roger Vione with Alex Brown for his thoughts.
You can learn more about the ETF Think Tank and Think Tank Exchange by visiting etfthinktank.com, your source of all ETF ideas, thought leadership, strategies, tools, and growth tactics.
And that's because our value proposition is to enhance yours. I'm Kedar Wilson.
And I'm David Dziekanski. Keep the exchange going with your clients. Until next time, take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness. Nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.